Well, time is passing. Why don't we talk a little bit about kind of a difficult area, and that is the non-discrimination and top-heavy rules and how they interrelate with plan administration and making some of these choices.
Right, right. Well, and that's, one reason somebody should use a third-party administrator is there is testing that you need to do, especially if you have employees. You definitely have to do the testing. There's no pass on that. And the government in various places compares what they define as a highly compensated employee against what's happening with the non-highly compensated employees. Won't get into the definitions, but and they would just want to make sure, that like a 401k plan, you can't set it up and the highly comp puts all the money in and nobody else puts any money in and off we merrily go. Mm-hmm. The government wants to make sure that things are fair, and so they have testing to make sure that there's not too much benefit for the owners of the highly compensated. And generally speaking, what you need to do to help pass some of those things are, a minimum contribution. It's not generally an onerous contribution percentage-wise or anything like that. Mm-hmm. But that is also how we take advantage of, like the class allocated allocations. We're able to do the testing and make sure that the contribution we've decided for the owner is meets the parameters that the IRS has.
Okay. So. Now, related to that, there are some ways to sort of avoid the requirement even for testing, isn't there?
In some cases, yes.
Like for 401k
In 401k plans, you can have what's called a safe harbor,
mm-hmm.
and there's two different contributions. One is 3% across the board for everybody eligible, or you can do a match. The easiest match roughly is 100% match up to 4% deferred. Mm-hmm. And if you use one of those two, then you get a pass on the 401k test. So the owner could put in, say they're over 50, 22,000, mm-hmm. and not worry about passing the test and maybe having to take some money back in out of the plan.
Right, okay. All right. One thing that we didn't have in our questions, but I know there's a requirement, maybe we should talk about it for just a moment, and there is a bonding requirement that applies.
Yes.
So maybe you could talk about that just for a moment.
Well, basically, it's bonding. There's a trustee in the plan that handles the money, and so it's a 10% of the value of the assets in the plan. So say you have $1 million, you need to have a $100,000 bond, and it's fairly easy to get. You get it through your business insurance person. There's actually a company that works with us online with third-party administration firms, and you get it online. Costs $150 a year, something like that. Mm-hmm. But that's in case somebody decides to move to Brazil and take all the plan money with them. That's what it's for. Ideally, that does not happen. It's there to protect the people in the plan.
It's supposed to protect the
people. And it is required.
Right. So. Yeah, so there are sort of these details that you have to attend to.
Yes.
There's also, aren't there like fiduciary standards that apply for some investment? Now, maybe not so much for the 401k, but for other types of retirement plans?
Yeah, there's fiduciary obligation that you follow the rules, basically, and then that's why you would work with a third-party administrator. They help you to make sure you're following all the rules. It's possible that trying to go on your own, you might, stub your toe somewhere. Not that you're intentionally trying to do that, but that's why you would want to work with somebody that can help you through all these things. And you are handling money, other people's money, if you have employees' money, and you just want to make sure that you're taking care to take care of that money. Mm-hmm. So.
Okay. Well, let's talk about maybe some more current issues and trends, things that are going on. Mm-hmm. What are some of the things that you see in your practice today?
Well, one of the big things that's out there now is fee disclosure. We're talking about the investments. The Department of Labor put out a regulation last July that there has to be more disclosure of all the different fees that may be involved inside of investments, especially in 401k plans. Mm-hmm. And they want that to be given out to the plan owners so that they can give that information to the employees, so that that helps them make a better decision as to how they want to do their investing and which options to choose. And it's been in the past rather difficult to sort out what all the different fees were and how they were applied. Mm-hmm. And now they've come up with a regulation to lay all that out. All the service contracts, if you've got a 401k plan, your service contracts are going to be updated by July of this year. That it's supposed to show what all those fees are.
Oh
So,
boy.
Yeah, so.
Okay.
Some other things that I've been having a lot of questions about in my practice is, like you said, alternative investments, real estate. And you can invest in real estate in plans. The biggest questions are to make sure you're following the rules right, so there's not a prohibited transaction or there's
Right.
not unrelated business income. And so the best advice is, if you're looking at getting into something like that, talk to your third-party administrator before you do it and kind of run through the test of, is this going to be okay for my investments?
Right.
So.
And you might actually want to get some legal and tax advice too.
Yes. Well, that's where the
Yeah.
unrelated
Yeah.
business income tax comes in.
Yeah,
Yes.
right. But the thing is you can't just like run out to buy a building that you're going to be using for your business.
No.
Yeah.
That's one of the
Yeah.
prohibited.
Yeah. So that's what
Issues,
you have to be
yes.
careful about is, you know, who's going to be using this stuff, and so on. So so you need to be alert and not just run off to do this sort of things willy-nilly. The other thing is, remember that this is a retirement investment, and that means that there's got to be some liquidity, and somebody's got to be able to get money to pay. You know, like if you have an
Yes.
employee leaves,
Yes.
and you've got a 401k plan, they've got to be able to get their share
Correct.
when they leave.
That's right.
So so there has to be
Well,
some consideration of that too.
Yeah, that's why you want to be diversified. You don't. The government doesn't want you to, and most investment persons I've talked to said you don't want to put all your eggs in one basket necessarily.
Right.
So.
Okay. Now, is there anything going on in Congress related to this stuff? They're looking at the tax laws.
Yeah, there's rumblings out there. I just saw something last week from my professional society, and I think it's coming out of that tax committee, that bipartisan tax committee. There's talk about lowering limits down to only 20,000 instead of right now the limit's 49 for a person to have go into an account, but limited to 20. Only a 20% contribution, some various other things that would substantially cut back on what people can put into a plan.
Yeah. If
So-
they do that, I mean, here we've got trouble in Social Security. We really need to be encouraging people to.
I know. That's
So
what
use
was so
retirement
nice
plans.
about the 2001 law changes is that they expanded a lot of things so that people could put, everybody, not just owners, but everyone could put a lot more money away. And you know, the reality is that the average median amount that somebody's put away is about $250,000, and that's for the age bracket 55 to 64, and that's the most.
And that's
Any
not
other
enough.
age bracket is much lower,
Yeah.
and that's not going to cut it.
So. Okay. Maybe we should talk a little bit about the Roth conversion and the availability of Roth for 401ks.
Right. 401k plans starting in 2006, you could have a Roth 401k, meaning you did not get a tax deduction, but you were able to put money in a 401k plan, and then that money accumulates, and at the time of retirement, when you take your money out, you don't pay taxes on anything. You can just take it out. You can mix and match that, so you could do half tax deductible, half Roth. And then one of the things that came out in September of last year is whenever you're at a point where you could take a distribution from a plan and say you did not want to take the money out of the plan, but you did want to convert it into a Roth account, you're able to do that now as long as the plan document has added that to it.
Right. So this is a new option, particularly to be able to convert funds that are already in a 401k to a
Correct.
Roth. Of course,
Correct.
that means that you're going to have to pay a tax.
Yes, you do have to pay taxes on it.
But for people who are pretty young, and if they're, you know, the tax situation is right and so forth, and especially if they look like, you know, their income is going to be growing in the coming years, it can be a real advantage and something
Yes.
to look at.
Yes, it can.
Let's talk a little bit about some of the reporting that's required. So do you just, you know, you got one of these plans, do you just include a form with your income tax return and it's all taken care of?
No, you have a separate form that you have to do that. If you have employees in the plan, it's a multi-agency form between the Department of Labor and the Internal Revenue Service. if you're just an owner-only plan, then it is just an internal revenue form. But they basically want a tax return to ask what you've been doing with the plan during the year. How many people are in it? How much money is in it? How much contributions did you put into it? Did you do any transactions that you shouldn't have done? They actually ask those questions on the form. So you know, if you have to fess up. But and then depending on the type of plan you have, if it's a defined benefit plan, there's an actuarial schedule that has to be attached and signed off. In bigger plans, you have other multitude of up to 5 or 6 different schedules that have to be added if it's a large plan to that.
Now, don't some plans actually have to have a financial audit by a CPA?
Yes. Any plan that has over 100 participants in it has to have an accountant's audit that's attached to it. And signed off by a CPA.
So a lot of people don't think about these expenses, that there are administration costs of having this annual tax return done, you know, reports for employees, getting this financial statement audit. So this is something really to ask about when you're evaluating what you're going to do.
Yes, yes.
How about ESOPs? Don't those actually need, now this is an employee stock ownership plan.
Right.
They actually have to have a valuation study done,
If
don't
they're
they?
closely held, they have to have a valuation done. Unless they are traded on NASDAQ or the New York Stock Exchange, they have to have a valuation done by an independent person to make sure that the value that's being used is fair.
Right. So in some cases, you can actually basically get a tax deduction for error. You can contribute company stock
Correct.
to the ESOP.
Correct.
That stock has to be valued. You have to hire a person that's qualified to do that.
Correct.
And then, based on that value, you actually get a tax deduction.
Correct.
So that's just one of the different ways that you can go about doing that type of a plan.
Yes.
But anyway, for some small businesses, if the owner is generous, and also for succession planning, it can be an alternative to consider.
Yes.
Okay, Phil, we've probably got just a little over a minute left, so maybe I'll just ask you if you've got maybe some words of wisdom to share with our viewers about getting into this area of a retirement plan for a small business.
Yeah, the words of wisdom are, you know, it can be technically complex, and you just want to make sure that you are working with someone that can help you through these types of things. And, you know, ask the questions and that type of thing, and make sure you're asking questions. I always like people to ask questions about things because I want to be able to explain it to them so they understand better how it works and how it works for them.
So get help and find somebody that really knows what they're talking about. That's important.
That's the best advice.
Okay, folks, retirement plans can be a key benefit and a key aspect of when you have a small business and being able to actually provide for your own retirement. You know, provided that you're profitable, that's what runs everything.
Yes.
Okay.
Yes. You have to have
So
profit.
anyway, with that, thank you very much for joining us today, and we'll see you next time on Financial Insider Weekly.